In this video, I will give an entire guide on how I managed to pull six figures a year from this strategy and still growing. But first, I want to tell you what the strategy is and why it's worked over a long period of time. Everyone is ready to teach their strategy, but nobody's ready to teach why it works at a very basic level. I also want to go into why I chose to not trade futures like everybody else. Before I begin, I want to start by saying I have been trading this strategy for 7 years now. I experienced many frustrations figuring out how to make this work. I just want to put this out there and say that I'm openly currently accepting only a handful of students to teach regardless of your skill level or experience. If you want to learn one on one with me, while I can't promise you results, I will do everything I can to get you to profitability as quickly as possible. If you're interested, feel free to email me in the description below. So let's begin. Trading futures is extremely liquid, too liquid. In fact, banks and funds can get in and out very easily. So you are quite literally in competition with some of the largest institutions in the world. Supply and demand are often not too heavily positioned against one another, such that it's very hard to tell which way things might go on any given day. In small caps, the size of the companies are so small that none of these large institutions can easily move in and out. Not only that, but these companies can also make 2 to 10x moves within a single day, which seemingly happens almost every other week. But it also makes your competition a lot smaller, limiting it strictly to retail and smaller hedge funds and banks. Due to this, the volume and price action can spike heavily at any given moment, given the inefficiencies presented on a daily basis. So, because of the less competition, easier price action to read, and just overall larger volatility, it becomes much easier to flip a small account into a large one. There are multiple ways to play this niche, but I know 7 and 8 figure traders who only go long, while at the same time knowing the same traders who trade only short also profiting just as much. I chose to short because many of these companies are hurting badly for cash. A lot of times, they'll release a press release just for insiders to sell into those who buy into large volume and issue what is called dilution. Dilution is a legal way for companies to sell stock in order to raise money for operations that seem fit for how the company seems fit. Oftentimes, they have more interest in keeping the company alive, or they just want to fill their pockets up knowing that the company is dying and have no interest in helping their investors. I'll dive into this subject a little bit later, but it is a huge edge that is very important to be aware of because our goal is to find when supply, aka sellers, might outweigh the demand, aka buyers. Because of this, you not only have sellers coming from retail, but also from the institutional side. Supply becomes much easier to play because you simply wait for the demand, you wait for the buyers to come in first, and then you don't have to hunt for the next play. You can simply just let it come to you. So this is how I scan for stocks. I take a minimum gap of 40%, minimum volume of 1 million shares, and float between 1.2 million and 11 million. The reason for this is because anything under 11 million, I still consider relatively low float, low supply, which is what we want because we want a lot of volatility. However, there is a such thing as too much volatility. Stocks that tend to fall under 1 million tend to be extremely volatile, and it's hard to not get stopped out in these stocks. They'll spike extremely sharp randomly and dump extremely fast randomly. It's just incredibly hard to play these type of stocks. So I just highly recommend staying away from anything that's too low or anything that's too high. But this is generally what I scan for. So this is a platform called Flash Research. It is geared heavily towards small cap traders. I really enjoy using this platform because not only is it a good scanner, but it also provides a feature in which you can look at the data of the stocks that you normally scan for. So here I'm going to show you, we're just going to simply go to setup analysis here. click on gap ups, and there's a bunch of presets that you can put yourself if you don't want to use mine. Um, but once again, we're just going to input our criteria, and we're going to look over the last 6 months. So just this year alone, and here it'll pull up some stats. And really quickly, I want you to take a look. So we have the gap day right here. We have the gap day right here. Okay. Now the average close direction of the gap day is 68.58%, almost 70%. That is a lot of edge that you can extract from there alone. Of course, some of these stocks can go up as high as 1,000% within a single day. It is very important to have risk management. You can't just short the open, know that 70% of them are going to close low, because it only takes one to knock you out of the game. Risk management is very important. Okay. So now if you want to deep dive into how to find edge within this niche, you simply just go to gap list and it will give you all the tickers and all of the key important data that you need to know. It has the volume, pre-market volume, what was the high from the open, what was the low from the open percent wise. Um, you know, it has the pre-market high, it has everything you need to know. It even has the high of day time, the low of day time. You can look for confluences within the biggest faders to really maximize your edge as much as possible. So let's go over our edge. So we have 70% of all gappers close red. We know that, of course. But if we narrow it down just a little bit, let's say we only take downtrending daily charts, right, in which there are potentially bag holders in the stock that are looking to sell on any given pop or any given press release, right? That is a form of supply. You might have sellers come in there. You also have dilution. So I'll explain a little bit about that later, but there is a website. I'll show it to you guys. But these are the 4 types of dilution that you need to be aware of. And if you get a good understanding of all 4 of these and how they work, you can truly maximize your edge. I know traders who live off this stuff and they understand it extremely well, more than anyone else, and they outperform everybody. It is a lot of detailed work, so it's a lot of understanding, but even on just a basic understanding of it, it will help you a lot, I promise you. So, and then we have retail bag holders. We also have the intraday, like people who are buying the hype into the press release, and then they're just holding it all the way down. We have retail bag holders and chasers, and we also have institutional and insiders who could potentially be selling. If it is heavily held by institutions and insiders, and the stock seemingly is just going down forever, they might use a day in which there's a lot of volume in order to liquidate their position. So these are several different types of supply that can come in once you start to see a press release come into a toxic company. So I kind of want to quickly go over the topic of risk management. It's very glossed over, and I will probably gloss over it as well because I have a ton of content I could create revolving around risk management, but it is a very important that you never have too much conviction in any one singular play. I don't care how much dilution there is. I don't care how, what your thesis is, like how A+++ you think it is. If a stock does not go in your favor, you got to take your loss. The number one thing that kills people in this niche because of the volatility is conviction and the position size that follows that conviction. Always have the appropriate position size and always take your loss at 1%. You should risk no more than that. Okay, it's okay to risk less than that, but never more. Be very careful with your position sizes and always take your losses when you're supposed to. Again, this is a numbers game. Let the numbers play out in your favor. After hundreds of trades, thousands of trades, you will see a positive equity curve. But if you let one or two or three trades one day take you out, that's going to set you back weeks, months, or even take you out of the game completely. No one day or trade is ever worth losing weeks on. Okay. Please be careful when executing this strategy. It is very important to have the aptitude to always be on top of your risk management. Next, I want to say that in order to have this strategy work, you need to experience losing cycles and you will experience winning ones. Right? There are going to be times where you're not making anything. There are going to be times where you're bleeding, but there are also going to be times where you're winning consistently. Develop a system, backtest it, and execute it. That's all you have to do. Now, I want to talk a little bit about the fees and brokers. So, there are fees associated with this strategy. About 30% of your fees are going to 30% of your profits are going to be deducted from these fees. What are the fees? They're basically called hard to borrow fees. Um, these stocks have very limited supply. In order for you to short them, there need to be shares available that you need to borrow from the broker. The broker will typically charge a premium for these, and I would personally not pay any more than 5% of your total position. 5% is okay. You can give or take based on what's happening with the stock, but as a general rule, I try to not pay any more than 5, maximum 10% of your total position. Um, so for anyone who has less than $10,000, I would recommend Trade Zero. If you have over $2,500, so between that price range, they're a good broker to go with. Not all brokers will accommodate to this strategy because not all brokers offer those locates. However, um, if you have more than 10,000, I would recommend Cobra Trading. And if you don't have enough money to even get started with Trade Zero, I would recommend a prop firm. You can find the prop firm within my link tree. They're called Trade the Pool. So we'll go ahead and add this here. Under 2.5K. So if you have less than $2,500 and you want to get started trading, you can do so with Trade the Pool. I typically don't recommend prop firms that much because you cannot simulate the same emotions and pressures that you get with a live account. I would recommend a live account and place small size risk, get used to the pressures and the emotions of, constantly winning and constantly losing. It will be much more real than trading a prop account where you buy a simulation. Um, so, given everything that I've laid out, it's really hard to see how you cannot consistently spot an opportunity to profit from the strategy over many trades with a small account. If you develop a proper system surrounding the strategy, I mean, because the whole goal here is to find where supply and sellers might overcome demand. I teach my students a foundational way for even beginners to learn how to make their own system within my course inside my link tree. Um, it is important to have a baseline, a foundation. It's important to know how to get started. If you follow everything in this video, there are so many ways that you can identify how to spot when sellers are going to overtake the demand and how you can look to take advantage of that arbitrage. Not all stocks are going to go down. That's why it's very important to know what you're trading, know what a winning trade looks like, know what a losing trade looks like, do your due diligence, study a lot. If you want personalized help, once again, because all of it seems too confusing, I'm looking for a handful of students to teach one on one and personalize all of the principles and all of the concepts that have gotten me to go full time. Feel free to email me in the link below if you're interested. Thanks for listening.